If you're thinking of taking your tax-free cash before the budget, just stop and take a second. Because for some of you, this decision could cost you tens of thousands. In the next few minutes, I'm going to show you exactly why, and also more importantly, how you can assess this for yourself when thinking about this decision. With all the speculation swirling around potential changes to tax-free cash in this upcoming budget, I felt it was worth making this video because for some, rushing to take your tax-free cash could be an enormous risk. Although for others, it might just be a degree of risk, and I want to try and help you understand the differences. I was really on the fence about making this video. I've got financial planners I deeply respect who take the view that there's just no benefit in making content on anything that could be seen as speculation, and I do understand that perspective. But to the same extent, I think when there's so much in the media around this kind of thing, it's easy to just feel out of touch not reflecting on it, especially considering I've done over 100 videos on personal finance and retirement planning. And this is something that's happening. Official FCA statistics paint quite a stark picture of recent behavioural response to this speculation. In 2024-2025, the financial year, 18.08 billion was withdrawn as tax-free cash, compared to the 11.25 billion in the previous year. Now that's a 61% increase, representing the highest withdrawal rate on record. So whether I make a video or not, people are increasing their withdrawals from the tax-free lump sum. So I wanted through this to hopefully provide some wider context, try and remove some of the hype and put you in a more informed position. If you don't know me, my name's George Agan, I'm a chartered financial planner. I've helped thousands of people retire without worry. So in this video, I'm going to break down why we have the speculation yet again about tax-free cash being reduced. Spoiler alert, happens in every budget. Why I personally think the government changing tax-free cash amounts would be a huge policy mistake. The risks and trade-offs to be aware of if you do decide to speculate on this, so at least you're in an informed position. And who I think could be making a really expensive mistake by taking their tax-free cash purely based on speculation. And what I think we need to do to fix this kind of problem happening going forward. I just want to say before I dive in, it is your right to do whatever you want with your money. Nothing I'm going to say is intended to change that. And secondly, as an advisor, while it's key to help support and discuss things like this with clients, any decent advisor can only ever act based on the rules at the time. Any regulated advisor has to work with their clients to help achieve their goals, not to take a punt on potential rule changes. And finally, this is a personal finance channel. It's not a political channel. When it comes to legislation changes, especially ones that affect your personal finances, I have to talk about it, but I have no desire to make this channel political in any sense. So I'm really commenting on this purely from my domain expertise as a financial planner. With all that said, why do we have this speculation around the budget? Well, borrowing costs in the UK continue to soar. Costs of long-term UK debt hit a 27-year high recently. Productivity is still much lower than it should be in the UK. And the government has struggled on a policy basis to cut key costs, things like welfare and things that they wanted to do. If you add all that together, put simply, in the UK, the cost of our debt is climbing and there's no sign of us at this stage growing our way out of it. So it doesn't take a genius to work out that in this budget, the Chancellor is likely going to have to come back to the British public and generate some more money from the tax base, whether that be increasing taxes or reducing some of the tax reliefs. Now, pensions are a key part of that, and the relief for pensions is about 50 billion, and I'll show you through this government stats. And because of that, the tweaks are very tempting for the government. And it feels remiss of me not to say as well, Torsten Bell, the current pension minister, has worked for the Resolution Foundation and they've done papers about reducing the tax-free cash. Although important context here that I think shouldn't be missed, in the same paper he also talks about reforming council tax, changing entrepreneurs or business asset disposal relief and inheritance tax. So it's important we don't speculate too much and get ahead of ourselves. Many ministers say or support things across their earlier career that doesn't necessarily make it into final government policy. He has also been involved in papers talking about cutting the ISA allowance to 100,000. At the end of the day, the Resolution Foundation is a think tank which is aimed at houses with low and middle incomes and those vulnerable to financial shocks and trying to reduce inequality in wealth. So it's fair to say that a lot of the policies are going to be around supporting that change. So an interesting point here is, let's say you did decide to go on the speculation, took your tax-free cash and then got hit with ISA cuts. That means that in taking money out of your pension, you could actually get wrong-footed here and not have as much money to go into an ISA. Again, I don't think that's going to happen, but it's just important to bear in mind the risks when speculating. Now, tax-free cash is an area of pension taxation a lot of people know about, but if we look at pensions more broadly, it could be argued that there are many other areas of pensions to change which might be easier. You could add in things like national insurance on pensions, which are currently not applied, or make wider changes to tax relief. So instead of marginal rate, you could do a flat rate of 30%. One could argue this would be a more intelligent approach to raising tax revenue, for reasons I'll explain in a second. And the reason I'm saying this is that they may not change tax-free cash at all. It is equally plausible that, tax-free cash sits in the too hard bucket, and instead of pensions altogether, governments, if they're looking to raise additional tax, look at council tax reform or freezing bans for longer. Ultimately, it's all speculation, and while I'm focusing in this video on tax-free cash, I could make an entirely different one on council tax reform. I do, however, think that changing tax-free cash would be a huge policy error. And I'll go through some reasons now why I think that. I think the biggest one is the knock-on impact for public trust in pensions. Tax-free cash is one of the few things that people almost universally understand about pensions. It's known as a key benefit. And I can say this after speaking to a huge number of people over my career. There is always a degree of mistrust around pensions. We do have history here from the Maxwell scandals in the 90s where workers lost pensions almost overnight, to more recent changes that have caught people off guard. The changes to pensions being put in the estate for inheritance tax. Pensions are incredible retirement vehicles, but the fact that governments can and do change the rules means they are met with some skepticism. The reason I think this is so risky is that we are already in the UK undersaving for retirement. People aren't putting as much as they should ideally into pensions. And I know there are many reasons for that. But the government's own sources say that 43% or 14.6 million people are undersaving for retirement. And get this, higher earners are more likely to be undersaving. The reason behind this is that if you earn more, sometimes the cost of your lifestyle can cost more and you need to save more for retirement to meet that. So if you're not, for example, saving larger amounts, you can get caught out. It's my belief that if the government changes tax-free cash in sort of a misdiagnosed approach to try and level the playing field, we could create an intergenerational moment that people look back on and use as a key reason why pensions couldn't be trusted as a savings vehicle. Now, that's not what anyone needs, regardless of what party you support. The implications of that going forward might not show up on a government spreadsheet, but I think would be huge. So number two is, I don't think it actually will raise much tax. I don't think changing tax-free cash will raise much additional tax, because if we think this through logically, say you decide to cut tax-free cash, how many people are then going to go out and maintain their current withdrawal patterns? I would wager nearly none. When we make these modelling assumptions, it's quite rare we seem to factor in change in human behaviour. Yes, people would be angry, but I don't think there would be many people that would suddenly take the same large lump sum from their pension in the same way they would have had before if the tax-free cash was cut. Which means that any hypothetical tax increase as far as what you'd receive would be just that. It would be hypothetical. This isn't me speculating. We saw this recently with capital gains tax increases. The OBR, in a recent publication, noted that the capital gains tax rate increase has actually resulted in less tax being raised, at least in the short to medium term, due to false stalling, bringing revenue forward due to the changes, and a significant behavioural response reducing the tax base. This kind of demonstrates a classic challenge with any tax raise, which is that you can actually reduce the revenue due to behavioural responses. And these concerns were raised by the IFS and others before the budget. And number three is kind of on a similar theme, but it's the knock-on effects of taxation raised. If you reduce tax-free cash, one of the ways that people could engineer trying to reduce their tax burden on their pensions would be, if they can afford to, retire earlier. The logic here, especially around flexible pensions, is that if you get stuck in a position where you, for example, are looking at your bands and you go, well, actually, it's more advantageous to retire early so I have basic rate bands and my personal allowance for longer, many people will take that decision. And a load of consultants in the NHS probably would back that up as far as feeling burned by pension legislation. This would hardly help the government's long-term aim to increase taxation through this measure and would actually work against them. Reason 4 is potential legal challenges or public sector relation issues. So if they did this immediately, I believe it could probably be subject to some sort of legal challenge. And considering the enormous amount the government has spent on the McLeod remedy, they should probably be cautious around making huge changes to pension legislation. Now, changing the pension commencement lump sum allowances isn't anything like the age discrimination issues around the McLeod remedy. And for those who don't know, the government effectively tried to change the structure of some public sector pension schemes, and it was found later to be age discrimination, causing a very costly and long remedy period. But as these tax-free cash pots often do sit with those that also work in the higher positions in the public sector, it does risk also reopening a fierce row with them, especially at senior level. I think regardless of public sector or private sector, it is hard to square that circle. If you imagine the person turning 55 the day after the budget and they make the change immediately, who had been planning for years to pay off their mortgage so they can go part-time, it seems almost unreconcilably unfair to make such a swift change. And there's huge historical precedent that through previous reductions to the lifetime allowance, which had brought down the tax-free cash previously, there was always a transitional protection put in place so people who had larger tax-free cash wouldn't lose out. So if they did do it as an immediate impact, it would really be the historical outlier by a long way. And my final one is that they've already got stealth cuts to tax-free cash built in. This is quite interesting. When the lifetime allowance was abolished, it was replaced with the lump sum allowance. Now that's kind of technical waffle for tax-free cash, which isn't actually called tax-free cash, it's called pension commencement lump sum. Anyway, waffle. It is 268,275. And that is a number. And that means that the government has effectively, if they just keep that number, already cut tax-free cash if they just maintain it. If they just do nothing with it and they let inflation run its course for 20 years, then the tax-free cash will be worth half as much today, pretty much, in real terms. They would get pretty much zero political backlash. I would argue, why would you risk the headlines when time does the job for you? So I've given you all the reasons why I think it's a really bad idea, but unfortunately that doesn't really give us any insight to whether it's going to happen or not. Now let's talk about your position and the level of risk that you might be taking if you do decide to act on speculation. And I think there's a risk in doing this for anyone, but the risks for some are significantly higher than the risks for others. I think what a lot of it comes down to is where you are on your retirement journey. Let's say we've got David, he's 55 at the moment, and he has 400,000 in a flexible pension pot. That's a defined contribution arrangement. He's still working, and he's heard a lot in the media about them cutting tax-free cash, even though there's no sources behind this. And he's really worried about the budget speculation. He isn't planning on retiring anytime soon. In fact, he plans on contributing for some more. But tax-free money is tax-free money, and he wants to take it. So the first question is, what is he going to do with that money? Let's say it's 400,000, and that would give him 100,000 tax-free cash. That's clearly much more than an ICE allowance of 20,000. Yes, if he's married, he might be able to split it with his spouse, so 40,000. And then maybe do that over the next tax year as well, so that's 80,000. Use premium bonds in the interim. Doesn't sound too bad. If he is single though, that's 5 years to shelter that 100,000. And if he wanted to invest it, so it was like for like as far as a chance for growth, that means in year one, 80,000 would sit in a taxable account and potentially give you taxable income and potentially capital gains. If he holds it in cash, then he's likely going to get less growth than an investment. And also, if he's already maxed out his ISA allowance, then only £25,000 cash at a 4% interest rate would use his personal savings allowance if he's a basic rate taxpayer, because the personal savings allowance is £1,000 per person per year. Now, if he's a higher rate taxpayer through his work, then it would only be £500. So again, at a 4% interest rate, that would be £12,500 he could get without paying additional tax. So he's not avoiding tax, he's kind of just shifting tax. I know though, I can hear you that ultimately, that could be nothing compared to what would happen if you lost 100,000 in tax-free cash, and I get that. But where I think the real risk is, if you're on the saving journey, is that in crystallising the benefit, that proportion of the pension can no longer grow. And what happens if you haven't taken tax-free cash is the tax-free cash wouldn't be able to grow with the pot. Effectively, in crystallising the benefit, you no longer can take any tax-free cash on that. And especially if it's much lower than the 268,275, that means that you are losing out on potential future growth you could be entitled to and more tax-free cash as a consequence. Let's look at an alternative reality. Let's say that David doesn't do anything and he doesn't retire for another 10 years. Now let's say his pot is 800,000. That tax-free cash has grown with it, and there was no cut in the budget in this scenario, So that 100,000 has become 200,000. So in that decision, David has effectively cost himself 100,000 of tax-free cash by panicking. Now you could say that, well, the 100,000 he could have grown as well and it could have ended up in the same position. But I think that's also missing this point, which is probably the biggest risk. Because David, if he did take the tax-free cash, would have to be very careful in relation to ongoing funding, because there are what's called pension tax-free cash recycling rules. Pension recycling is where an individual recycles either their tax-free cash or pension income back into a pension scheme. Because the reinvestment can generate extra tax relief for the individual and build up a fresh entitlement to tax-free cash as long as they haven't taken the full 268,275, HMRC understandably objects to this, because effectively people are using tax-free cash to create tax-free cash. And for that reason, they have recycling rules. What has to happen is you have to receive tax-free cash, obviously. Because of the lump sum, the amount of contributions paid into a pension scheme has to significantly increase. The additional contributions are made by an individual or someone else, like an employer, and the recycling was pre-planned. There are thresholds that HMRC use to assess this, and the thresholds are: the total tax-free cash payment over a 12-month period must have been more than 7,500. As far as a significant increase test, contributions have to have increased more than 30% of what they might have been expected to be due to the payment of the tax-free cash. So that's basically 30% more than what you were doing previously. So to go back to David's situation, let's say David took the 100,000 tax-free cash and his normal contributions were 20,000 per year. HMRC could potentially investigate if he met all the other criteria and his contribution jumped to 26,000, because that would be a 30% increase. The other criteria is the increase in contributions must exceed 30% of the tax-free cash taken. But there is a testing period that HMRC can look at contributions made, and that works as far as the tax year that tax-free cash has been taken and the 2 tax years either side. So kind of like 5 years in total. I know there's quite a few rules, so I put a link in the description about these rules, which I would strongly suggest checking if you're anything like David and thinking about this. But effectively, what this means in really simple terms is that you might be able to maintain your current contribution rates, but if you take your tax-free cash early, especially on the build up to retirement, you're going to then have to be very careful on pension funding through a defined contribution scheme. The thing is, for most individuals, you might be at the point where close to retirement, you want to maximise the funding opportunities that are available for you and the tax reliefs. I think it's really worth thinking about that, and if it's worth speculating on the changes on something that might not happen at all. So I would very much put David's situation as in highly risky and potentially really going to backfire. Now let's think about someone who the risk is less. Let's use the hypothetical example of Sam. 65-year-old, retiring now. And there is still risk here, but not as much. Sam's done really well. He's already maxed out the most he can get in a pension and take the full tax-free cash. So he's basically sitting there looking at 268,275 as potential tax-free cash. Now Sam does still hold the risk of, well, what do I do with the money? I can't really put it into tax-efficient wrappers. I can consider investment bonds if I go beyond ISAs, but do I really want to go through all that kind of hassle? The thing is as well is that because of the size of his pension pot and the value of his home, Sam does have some inheritance tax issues. So if he did take the full tax-free cash, while pensions are going to be inside the estate from 2027, if he does this now and he passes away, he would be bringing money into his estate earlier than he would need to from an inheritance tax perspective. Now, if he's married and can use the spouse exemption, he might not be as concerned about that. But if he's divorced, that could be a huge issue if he cares about legacy. You know, sometimes I think people are saying, should I take more money out of my pension to avoid inheritance tax? And it's kind of an answer you've got to be, well, hold on, is that right for you? Because actually, especially if you act on it now, you're actually moving money into your estate, and you can then gift it, but you need to live 7 years for that to happen. So initially, without a doubt, you would have made the inheritance tax position worse, not better. So you need to be thinking about both parts of this strategy. Now, going back to Sam's position, clearly, if there was a cut to tax-free cash, he could be quite exposed to it. And because he is a finished work, he could then think about, well, I'm not going to be using my ISAs going forward for funding for the next few years. And maybe between me and my spouse, I can fill our ISAs over years. And yes, I will lose some tax efficiency, but ultimately I am securing the tax-free cash amount. I can understand that perspective, even though there are, of course, downsides with that. Ultimately, you are still taking money out of a very tax-efficient wrapper where your investments can grow free of income tax and capital gains tax, putting it into your estate and then having to sort it out probably in a way which is tax inefficient. With both David and Sam's position, they are speculative. I would argue that Sam's position is slightly less risky than David's because of all the extra rules and the saving position. But we're still in a position where we don't really want to be making life-changing decisions purely based on speculation. Tax-free cash is an irreversible decision. This was confirmed in a HMRC newsletter because one of the things that people were trying to do with the last budget is take tax-free cash and then cancel it. They've effectively said in the newsletter that once lump sums are paid, the associated tax consequences, including use of lump sum allowance, cannot be undone. This followed a wave of people who withdrew tax-free cash before the 2024 budget and then tried to reverse the decisions when no changes materialised. The FCA actually issued parallel guidance confirming tax-free cash withdrawals are not covered by cancellation rights. I think, regardless of where you sit politically, the thing that I take the biggest issue with all of this, whether you believe pensions should be in the estate for inheritance tax or not, is kind of irrelevant. I think what is an issue around pension rule changes is that if people have planned using rules for the last decade or so, then whether it's tax-free cash or inheritance tax changes, changing them quickly is brutal because that individual may not have taken the same decisions had the position been consistent. What we really need to fix this is we need a long-term commitment to long-term savings policies. I know that might sound naive, but it's what we need in this situation. Ultimately, when these tax changes happen, whether this is pensions being inside the estate, whether this is a potential change to tax-free cash, which by the way, I don't think they will, or whether this is changes to national insurance, ultimately, if we take a real step back, and if the government was willing to be more thoughtful about this, I think they'd probably realise that they lose out by these actions as well. Yes, they might have happened to raise some tax revenue in the interim period, but by doing all these little tweaks and changes, there is such a knock-on impact as far as the lack of trust it creates that ultimately I'd argue it undermines the long-term vision any government or country needs on what retirement savings should look like. They should be long-term vehicles that can be supported for long-term decisions. So again, it may be naive for me to say, but a cross-party solution and a long-term commitment is the right thing. And I know AJ Bell have done some work on it. And yes, I have signed the petition. I'm not saying that the pension system shouldn't ever be changed. I'm not saying that tax-free cash is untouchable forever. What I am saying is that if you're going to make changes, do it properly. Give people time to adjust, protect those who have already planned, and more importantly, make a commitment that gives people the confidence to save for their retirement without constantly looking over their shoulder, wondering what's going to be changed next. I really wish we didn't see these things, these speculative positions in the media, and the government actually could do something to change this. They could make a long-term commitment. So I hope just talking this through, you're feeling a slightly more informed position, and I hope it will put you in a position to make better decisions. Generally speaking, it's never a good idea to act on speculation. If you are still saving, be really cautious about it and ask yourself, why would I be doing this? But do make sure if you are going to do anything like this on speculation, think through it deeply, consider all angles, and ideally run the numbers. Anything from newspaper headlines are not here to support your financial future. They're just here for your attention. I hope that has given you a background, some things to think about, and you're in a more informed position. If you want to watch a more recent video on the inheritance tax changes to pensions, feel free to give it a watch there. Either way, thank you so much for watching.